Waiting for
Yeah, yeah, I think I now at least I become a very important person because
yeah.
for important person you'll have to wait now. Sorry to make you waiting.
No,
And
that's okay. That's
I
okay.
was about to say that too much of anything is not very good because we had a seminar in the morning. Then again they went for lunch. They have to again get back, and again they are all back because a very important person is here. And I'm referring to Sri Ayyappan Nair. Ayyappan Nair is that way not a stranger to Gujarati Institute. He is the second visit. Last year you were here. No? I was unfortunately not here at that time. And he belongs to Trivandrum itself. And he has been with RBI for now how many years? Almost 26 years. I think before some of you are born. Uh, so I'm very happy to know that he has got a wide range of professional expertise, including his training in Yale University that makes us a little bit more closer. And thank you very much for bringing this report, which has got released. And now thank you for sharing the report and sharing the insight from the report with us. And I was actually looking for who will be the real what is called discussant. Uh, so we have internally a lot of people, but uh, because even if we do not know, we are the finance people, after all. But we searched for a lot. Then ultimately we found only if Professor Banamurthy is not available, we'll go for another person. So I know that he's always very busy and travels a lot. And when I was talking to his vacation, he told he's a professor, but no vacation. So now thank you very much for joining. And I'm very happy that we are doing a lot of things together, Madras School, and we are doing a lot of things together. And ideally, you should have been here today, but anyway, online, we can, online, we'll be happy today by having you online. So I welcome Sri Ayyappan Nair and Professor Banimurthy, and of course, all my colleagues and others, those who are joined online for this very important meeting, wherein as RBI's financial stability report, apparently it is having some interesting results. I had a quick look at, you shared the report earlier. And if I start talking about that, you will be getting unnecessarily bored with a very interesting report. I don't want to do that. So I will, with these words, I will invite Sri Ayyappan Nair to present.
Yeah. Sorry. Thank you. I just moved it.
I forgot that the second panelist is Dr. Anub is the second panelist. I forgot. I took him for granted, which he doesn't care. But as chair, I should not be doing it. I should not be doing it. He has an important role.
Where is Dr. Anub?
That's right. Right.
Yeah,
here.
yeah, I
Come
think
here.
we met last time.
Anub, come here. Anub.
Sonalika's-
Dr. Anub, come. Please come.
Can I get a glass of water?
Please. Yeah, this is your water.
Okay. Oh, it's there? Oh, okay. Upside down. Okay. Okay.
Anub.
So good afternoon, everyone. Professor Joseph, extremely delighted to be here. Like he said, I was here last year. I think we had an engaging discussion, and I see some faces during that time whom I've seen they are still around. I'm happy. I'm looking forward to similar kind of discussion. And to Professor Banamurthy for being here. I hope probably we can make Madras School of Economics as the next stop for doing the finance stability report over there as well. And then I'm looking forward to his comments. Please stop me at any point in time if you have comments, but obviously we can discuss at length at the end after the presentation is over. But in case if you think that something is not clear to you, I'm happy to take that on board. Uh, so the financial stability report we publish every half year. This is a report of there is a council in India to manage the financial stability, which is called the Financial Stability Development Council. There is a subcommittee of that, which is headed by the Reserve Bank of India governor and has representation from all the regulators. So it's a report for all of them. We take the lead and we normally write it and we take inputs from them. Now, this particular report was particularly challenging for us because the war started, right? And then it began at the end of February. And we normally start writing the report, and it takes about 2 months for us to draft it and things like that. But by the time we finished the draft, which was somewhere at the end of the last week of May, and then by the time it went to our top management, that is the governor and deputy governors, there is a truce in the right. There's an interim peace deal. Now you write the report thinking that okay, the war is going to prolong. So if the war is going to prolong, obviously, what is going to happen to India, right? We are a highly import-dependent economy. There's a lot of oil that we import. The oil prices were high. Our balance of payments were getting into problems. So you write all those things. And good for the economy, but it was a bad timing for us that the interim peace deal happened at that particular moment, right? And then you go back onto the drawing board, and then you have to again write. So obviously, we didn't want to change too much, given who is responsible for the war and given his daily nature of tweeting out things. There was no, hope. And as you can see, probably right now, what's happening back in Iran. There was no way that the war is going to stop. But we can't write that the war is going to prolong. So we change the word to supply chain disruptions might continue, right? Just leave the same message, but tweak with it. So that was this thing. So we had to change quite a bit of the narrative around the report as such. But the thing about financial stability is quite a lot of these things just fester in the system for a long period of time. It doesn't change. It's just that the nature of the shock changes, right? So this time it could be, I think when the last time when I came here, probably it would have been the tariff. That was the case. And this time I'm coming here, the shock is there. And as long as Mr. Trump is the president, rest assured, I have enough things to worry about, right? He will give me enough material to write, so I don't have to worry about that. But that's the nature of the job. What I'll do is I'm going to focus mostly on the Indian system, but there are a bit of things on the global which is very important for us to understand. And so some of those things are, one issue is obviously that's an area that you all look at, which is on the public debt, right? Now, what's happening on the public debt is that, I think that this works or okay. So for the first time, if you look at the chart on your left, which is the global public debt, we are going to reach a level of global public debt that was last seen during the World War time in the 1930s and 40s, right? We are going towards that level. That is large amount of debt. Now, there are different ramifications of that debt going so much, but from a financial stability angle, what happens is that when a government issues debt, who is going to buy the debt? Okay, that is what worries us. Previously, most of the government debt were bought by what you call as price insensitive investors. These are ideally banks or insurance companies. They are essentially, they buy this debt and they hold in their book for a long-term purpose, right? And what happens is quite a lot of this debt, because for accounting reasons, what you say is they don't have to mark it to market. So they don't have to book any gains or losses or anything. You can just keep it and you call it as held to maturity. Now, what's happening in the world is that the bank-dominated financial system is giving way to a non-bank dominated financial system. In the West, it is already the non-bank dominated financial system which is bigger. In India, it is just a matter of time that the non-banks will become bigger than the banking system. Now, the problem with non-banks, which is like the hedge funds and others, which is in the middle of the graph, is that they are extremely price sensitive. That means even for small changes of price, they just act on it. Okay, why they act on it? Because quite a lot of the position they build up is through leverage, right? And so that means they borrow a lot and then they take large amount of exposure. So small changes in price, they just sell it off, right? They are not going to wait. They are not going to be the price incentive guy like the banks and other things. So now that means essentially there will be a lot of volatility in the market. Now, the problem with government bond market is that because that is the fundamental pricing mechanism for every asset in the system. So if a bank wants to give a loan, they are going to use that as the reference for your. So if you're going to take a housing loan for 20 years, one of the things that the bank will look at is, okay, what is the 20-year government borrowing rate, right? And then they add what you call as a risk premium on the individual borrower, right? And then they add a premium to that, and that's all. So if the base rate goes up, our cost of borrowing goes up. It's as simple as that, right? So, and the volatility keeps on creating these problems. Now, what the governments are doing, so the governments are increasingly, because of these things are happening, they're increasingly borrowing short term. Okay? Because if you go long term, investors are saying that I don't think that this is sustainable. And if you want me to buy a 10-year debt or a 20-year debt, you jolly well pay me another 50 basis point. So the government says that, okay, I don't want to borrow at such high cost. So then what I do is I just buy short term. I just borrow short term more and more, right? And that is happening. The problem with short term is there is a risk of rollover. Every 1 year you have to roll it over. And when you go to the market to roll it over, the market may not be asking for a higher rate, or they may say that I don't want to roll it over. Either ways, the public debt, the global public debt has reached a stage where it has become quite unsustainable. The problem again here is, as with everything in the world, the good and the bad, everything begins and ends with US. The US has the dollar as the reserve currency. And that means US can continue to borrow. Everybody wants a piece of US financial asset, right? So they all give money to the US. So they continue to borrow. And as long as they continue to borrow, and just like the Iran war, because they have enough strategic reserves and other things, they are not impacted by the price of the oil. India gets impacted. Okay, debt becomes a problem. Tomorrow, the rates go up, it suddenly gets spilled over to our markets, right? So we are the bystanders who will be getting affected because of that. The second big issue that you all might be looking at is the growth in equity markets, especially, right? So the artificial intelligence is going to be here, right? There is no way to escape. People are looking at probably the mother of all inventions, right? That's what people are thinking. It is going to take over quite a lot of the jobs. It is going to take over the way we work. Those are things going to happen. So there is a massive amount of debt exposure in terms of you are taking a massive bet on artificial intelligence. Okay. And because US is the epicenter of that, there is a lot of money going into that. So what's happening? Equity markets have very high valuations, and these valuations are driven by few firms. There are just what you call as hyperscalers, right? Some companies, large ones like your Meta or your Google, your OpenAI, some of Anthropic, some of those companies there, and then they are massively investing in that. Now, what that means is that the world's exposure to US equity markets, which was around $7.5 trillion in 2020, has gone to $21 trillion. This is just equity market. And now there's some work has been done by Geeta Gopinath on global imbalances. And according to her, the balance of payment number she looks at, and then she finds that this number is close to $45 trillion. That's the world's exposure to US. Okay. 45 trillion, you think about it, we are just a $3 trillion economy. Okay. That's the size of the problem that you're seeing. So the worry is that if there is a burst on that, and I sincerely hope that it is not a burst. Okay. Even though we are getting pummeled in our equity market because we have no AI trade, but we don't want it to be a burst because it is going to be the mother of all bursts. Because there is no significant, there is no comparison, the kind of exposure that is happening. Now, because they are investing more and more, what they are doing is they are investing. So previously what used to happen, so this is just the performance of the market, right? The red line, what you see is that if you take these hyperscalers, the market goes like this. You just take them out, the market is much lower. And the middle of the graph is showing that it is extremely highly concentrated. There are just few firms. So for example, anybody who is in the AI infrastructure, Korea and Taiwan, there are two companies in Korea, Samsung and SK Hynix. They are the chip makers, right? There's another guy in Taiwan, right? They are all these things. So very, very concentrated few firms providing all these things. Now, what used to happen previously was that all these firms used to have a large amount of free cash flows. That means their own cash flows, which they can use to fund these kind of investments. But they are running out of the cash flows because the kind of infrastructure investment they are looking at is $5 to $10 trillion. So then once you run out of cash flows, what you do? You go and borrow. So that means they are increasingly borrowing from the debt market. And the moment and they are getting into every form of debt market. And the problem with debt market is that if you see the first sign of difficulty, the debt market is going to say, no, I don't want to get into it, right? Equity markets are not like that. Equities are when you invest, when you buy a stock, you are essentially becoming an owner, right? You have upside, but when it goes to debt, you lose the money. Debt means you are supposed to get your cash flow back, right? So that is going to be the real challenge. If they continue to borrow more and more from the debt market, then this is going to be a problem. And so we don't know how this is going to play out. This is every day is becoming a bigger problem. We genuinely hope that probably it is going to deliver what it is promising. But it is too early to say that because there are so many issues associated with artificial intelligence. For example, you look at all the inputs that is going in, the chips, right? And those kind of things. For that, you need certain raw materials like silicon, right? So though everything is concentrated with few people. So that means if somebody withdraw it, so for example, if China decides to probably take over Taiwan, okay, that's the way they are going to do it, right? So each one is it's not just an economic problem; it becomes a political problem, right? And that's the world we are moving into. So it is one big challenge for everyone. I'm going to skip this one. Only bit I wanted to tell you is this, that the world is, as I said, that increasingly becoming dominant by non-bank financial intermediaries, okay? And what you see is the size of these things increasing, right? So where it was 2015 and where it is in 2025, right? These are, so back in the days when we used to hear the word billion, we used to think that it's a big number, right? Now nobody talks in billions because even Mr. Musk has already become a trillionaire, right? And you cannot believe that a company which is supposed to do something in the space, people are just valuing it, thinking that which makes $10 million now. He says that they are going to make 1 billion by 2031 with absolutely nothing to show. Okay, but they trust him because he has delivered previously, whatever it is. But that's the world we are in, right? So massive amount of the problem with this thing is everything is borrowed money, right? And a lot of people have a lot of money, so they all get pile onto it, and tomorrow it becomes a problem. You are going to get into this issue. Okay, this is largely about the world that we are living in. You have a lot of political problems. Geopolitics has become the center of everything, and that means you are not going back to the old world. I think we are done with that. I think Mr. Trump has ensured that no, we are not going back to the pre-Trump era. He might change, somebody else might come in, but it's very unlikely that the world is going back to that era because it is essentially nobody is going to trust one another because that's the world we have created. So that means everybody has to become independent. So for example, for us, it becomes energy independence, right? We have to have more reserves. Otherwise, suddenly such kind of a war happens where 90% of our oil import comes through the Strait of Hormuz. That becomes a choke point. You don't have oil to come through, right? So this is going to be the way that the world is going to move on. And so it is going to be increasingly challenged. So for anybody who is doing work now on economics, finance, you have to bring in the politics with that, the geopolitics. You cannot just untangle it and just say that, okay, I independently will look at politics and economics and finance. Just doesn't work because the geopolitics has extremely got entangled into that particular process. On the Indian market, okay. So what has happened? The simple logic is, okay, so we have a balance of payments problem, okay. Our balance of payment problem comes from the capital account, not from the current account. The current account is always been, we are a growing economy, so we will always have a current account deficit. Our current account deficit, everybody thought that 1% of current account deficit is easily financed. It can be financed because it requires about $40-50 billion. Till last year, we were getting that money. Now the problem is that because AI is the thing in town, is the only game in town, all money is moving out, right? So even for that 1% of current account deficit, we are not getting enough capital flows to fund that. If you are not getting enough capital flows to fund that, then naturally that means there is a lot of demand for dollars. Okay. And demand for dollars means the price of the dollar goes up. That means the rupee dollar exchange rate is going to depreciate, right? It's a simple way of looking at it. Now, if you see, this is what the currency depreciation that has happened in different crises. Now, it might appear that the West Asia conflict, the currency has depreciated only 6.3%. But you have to remember that the rupee has started depreciating from last April when the tariff happened. If I take from tariff time, it is almost 13-14%. Okay, and significantly, and this has happened only 13-14% because RBI has ensured quite a lot of intervention to smoothen the volatility, right? And that has happened. Now, one chart, leave aside the middle one, the right hand chart. Now, what happens in the market? These are all how the incentives play out. Imagine that you are an importer, right? You are an oil importer, and the rupee is depreciating. So, an oil which was costing, say, $100 a barrel, okay, you were sourcing it at, say, 92, okay, and in 2 days time it has gone to 95, right? What are you going to do? You have to hedge your risk. There is no other way, right? You cannot wait. So what you do is you go and you get into these what you call as forward contracts, and you essentially hedge your position. Now, if you are an exporter on the other hand, okay, what are you going to do? You will not hedge, because I know I have dollars today. That dollar is going to appreciate more. Why should I bring the dollar now? Right? So the only thing that is there in the system is tremendous amount of dollars. There are no supply coming from anyone else. The only person then who can provide that supply is Reserve Bank of India. So quite often people will say that, okay, I mean, this is one discussion that I always have with some of the time with the typical, I mean, the economics people who give commentary vis-a-vis policy making. The challenge is, okay, you can say, okay, let rupee go to 100. Okay, that was one of the tweet by Mr. Arvind Panagreya saying that these kind of, it's very easy to say these things in outside. But what happens in the financial markets is this becomes a self-fulfilling prophecy, right? The moment you say 100, it doesn't stop at 100, right? It goes to 110, it is because the market just, and also over a long period of time, the market has come to expect the Reserve Bank of India to ensure stability in the currency. And it is a mandate for us. When I say price stability is not only about inflation. It cannot be the internal value of the currency. It has to be the external value of the currency also I have to protect, right? I have to ensure that, because there are so many other variables involved, right? If for example, if your exchange rate goes to 115, how much, I mean, essentially the inflation that is going to drive because of when you convert the oil, right? It has its own implications. So it is not easy to do all those things, right? This is one of the challenges that we have, but we normally keep quiet on this. We don't articulate it that much, but in my personal opinion, there is a very justified reason. When you are in a vicious cycle, you have to somehow get out of the cycle. And if you have really ammunition available with you, you have to act. That is not the time for you to bring in the theoretical underpinnings of supply and demand, and this is how the prices will find its own level, all those things. It sounds good. So one of the classic quotation of attributed to Keynes, I don't know whether he said or not, is that the markets can remain irrational longer than you can remain solvent. Okay. So that's the situation. I mean, they can remain irrational for a long period of time. Can you and if you don't have the flexibility to do that, right? So you need to act as a policy maker. The other thing, because of this thing happened, now what is done? The moment a crisis happens, you come out with the reforms, right? So we announced one set of reform that the government announced was getting rid of what you call as the withholding tax on foreign portfolio investors debt investments in debt market. Okay, and how that has benefited us, right? This has been a long-standing demand from everyone. We are the only isolated country. You know, the two other countries which have this debt. Okay, you don't want us to be named along with them. They are Argentina and Pakistan. Okay, those were only two countries which were having this withholding tax on foreign portfolio investment in debt. Thank God they have removed that. Now, because they have removed that, okay, what has happened is, so you look at the two charts. This is the first chart, is when I had prepared the first draft. Okay, so what you are seeing, so there is a line which is called the yield curve. This is at different maturities. What is the borrowing cost for government, right? The red line was as on 27th February. That just shifted up as on 25th May. Okay. Then come the truce, and then we announced a bunch of measures. The government announced, we announced. That happened on around June 4th or 5th. And you look at where June 30th it is. It just came down, right? Simple announcement. What you're seeing on the right-hand side is the amount of debt flows that is coming through the foreign portfolio investment, right? Now, when we talk to people, this is again is a trust issue. One of the things that some of these guys say is that, okay, you have come out with a measure in a crisis. What is the guarantee that you will continue to retain this measure? Because India is tremendous, has a very bad reputation of doing things on a retrospective basis, right? You would have heard a lot of tax court coming and giving those kind of things. So if you are an investor, you need confidence, right? Because see, what we need to understand is, if you are a foreign investor, they don't have any obligation to come to India. They have enough markets to go. You and me don't have an option. You and me has to invest either in bank deposit or an equity market, something like that. They are choosing between you and a number of other countries. So how do you provide the best avenue for how do you make India as attractive, right? That is one issue. The other chart which I wanted to show is that, which is related to some of the work that you guys do, is the government borrowing now is largely, while the central government is trying to consolidate a bit, the state governments have gone absolutely crazy. Okay. They are borrowing enormous amount of money. Now, when the state governments do, so what is happening in the last chart is that the banks holding of central government securities have fallen off, but their exposure to state governments have gone up. Now, for a bank, they treat these both investments as identical, right? Because there's an implicit guarantee, there is no default risk. Neither do the Reserve Bank of India says that you have to maintain more capital because you're investing in a state government security. Everything is on par. So if you are an investor, if you're a bank, on a government security, I get about 7%. On a state government security, I get 750. Why wouldn't I invest in the state government security, right? Then essentially it has become like the tail wagging the dog, in the sense that the state government security, the government continues to borrow, their rate goes up. So if the government wants to borrow, the banks will say that, okay, give me a little bit more higher yield. The cost of borrowing for the government goes up, right? So these are all some of the challenges that you have. The difficulty for Reserve Bank of India is that I was glad that we were allowed to retain this chart and put it out into the report, saying that some kind of nexus is building between the banks and at the subnational level. We were not allowed, we were not asked to take it out. So there is one kind of policy in the sense that what we have done. This is bit of technical. I don't know whether you guys will like it, but I'll try to explain as simple as possible. So the banks, when they invest in government securities or any instrument, they have some different categories of investment. If you put something in a held to maturity category, you don't have to mark to market. You can just hold it to this thing. And then there are two other categories where you have to trade. Now, previously, what the banks used to do, anytime the government securities yield falls, so the government securities yield will fall, price will go up. Yield falls, they just transfer from held to maturity to the other category and book a profit. Now, what we said is, internationally, that is not a good practice. So we said that you cannot do that. Okay. You cannot just transfer whenever it suits you and then book this thing. Now, so what that means for the banks then? The banks see this as, okay, essentially, if I have to hold till maturity, I want a higher yield because I don't have the option to get out of it, right? So I might as well get a higher coupon on that rather than having a lower coupon. So that means you are going to continue to bid a higher this thing. And where do I get a higher coupon? On the state government. And state government sees that, okay, excellent, I'm able to borrow. Let me supply more government securities, right? I continue to borrow. The banks are there. They are willing to accept it, right? So, so internally, it's not it's a judicial policy that we have done, but this is how it is plays out. So sometimes these unintended consequences play out. Okay. The other big issue for us is that there has been a massive sell-off from the domestic equity market by foreign institutional investors. So So India has been the darling of, for example, the foreign institutional investors up and until September 24. Okay, our equity market was growing, we were offering high returns, so on and so forth. But now every penny of money is going to AI, right? So Korea, Taiwan, and all those things. And that means they are selling a large amount of money out of India. So what you see is 30.7 billion is in the first 6 months, which is almost double what they sold entirely in 2025. Now they are still sitting on a large amount of profit, so they can sell more. Now sorry. That is not coming. Okay. Now, the story on equity, again, people will say different kinds of stories about, okay, India is not getting its due and all this. It's a simple story of earnings. If you are Samsung and SK Hynix, they are returning a revenue of, say, 400% increase. Money will go there, simple logic, right? And here is the other issue with some of the issues. So we keep on saying India is the fastest growing economy, right? In real terms, that sounds good. But in nominal terms, what is our growth? Right? And eventually, for financial markets, everything is nominal. Right? What matters is nominal. If you are growing at a nominally at some sub 10%, companies cannot earn their revenue or can have earnings more than 10-15%. You will have here and there isolated, but most of them are on an average is going to converge about 10-12%. So in a world where there are companies offering you massive amount of growth, why would somebody stay invested in India? Right? So that is why I think that probably one of the things that I think probably before we were coming here, we were discussing about this whole obsession with debt to GDP numbers and all those things. There is no other alternative but to grow faster. If you don't grow faster, there are alternatives. That's all you have, right? And what you're seeing is the earnings are essentially. And if you're a foreign investor, you have to remember that their return is on dollar terms, not on rupee terms. So not only in rupee terms it has to go up, the rupee has to appreciate. The rupee depreciates, okay? And the third leg for them, which we are not adding here because then it becomes a problem with the government, is that on this they have to pay a capital gains tax. Okay? So if I look at the dollar and if you are dollar adjusted, tax adjusted return, you are not getting much. If you're not getting much, obviously you're going to get out of the market, right? And this is a problem for us. Why? From a macro perspective, because quite a lot of our capital account funding was coming through this direction. Because foreign direct investment, even though gross happens, there is a lot of net outflow is happening. And part of that is happening because a large amount of money which has come into startups 5 years back, they all have a gestation period of about 5 years. After 5 years, they take it out. So large amount of money coming in, but they are also going out. So your net foreign direct investment is not happening much, but the foreign institutional investment which was happening, that has also dried out, right? So it has become a clear problem for us on the balance of payment. And that is why Reserve Bank of India now has come out with an FCNRB deposit scheme, right? If you are a foreigner, you are just given, what you say, free lunch, so to speak. Because we need capital. So if you are a foreigner, you can literally earn almost 25% on your money. Okay. You just need $100,000. You go to a bank, the bank will give you 9 times of that. Okay. And that you can bring in. You can get a 6% return on that. And then what you borrow from there is at 4%, 2% easy pickup for you on millions of dollars, right? That tells you what? We are not in a good place, right? Because you won't do that kind of scheme unless you are not in a good place. And the only time we have done it is in 2013, when the rupee had a similar depreciation problem in an incident called the taper tantrum, right? So we just hope that this is going to be a short-term thing, but that is not. Okay, these were all some of the bad stories about Indian, right? The good stories. The good thing is that the Indian banking system and the non-banking system is in the best of its health, which is vital because you don't want the banking system to be bad, right? Because you don't want trust to evade from that. So their capital is at a very high level. Their NPA levels are at very small, lower levels. Across parameters, they are doing relatively well. But even then, my job is to keep looking for issues, right?
Decimal bank.
Yeah, I mean, even when the things are appears to be good on the surface, okay, are there problems somewhere in the down below which I need to identify, right? So one of the things that we looked at was so what's happening in the way that we are functioning is that banks rely a lot on what you call as savings account, right? We all maintain an account with the bank. We get about 2.5 to 3%. We don't complain about it. Okay. Now, why you don't complain? You wouldn't have thought much, but the simple reason you don't complain is because it gives you convenience. Okay, it is just that I can at any point in time I want my money, I can just go to an ATM, withdraw it, or else if I want more, I can go to the bank and branch and withdraw it. I have given other facilities like, for example, using your phone, you can transact using UPI, you have internet banking, so on and so forth. So essentially, what the banks enjoy is what you call as a convenience yield. So the same amount of money, which if you are invested in with a you are giving it to somebody else, you would have asked for say 5-6%. You are giving that money to bank at 2%, essentially because that 3% is the convenience yield that the bank extracting from you, and you are willing to give it, right? Now, this has been the story that has been going on. Now, what's happening is that increasingly the younger generation and people essentially are seeing equity market is booming. Okay, so why should I stay invested in bank, right? Even if I give a fixed deposit to a bank, I get about 7% return. And then you adjust for inflation and you adjust for tax, you are essentially getting a negative real return. So the better thing is, okay, equity market may not be doing exceedingly well, but it is still giving you a 10 to 12% return. So let me put the money in equity market. So what we all have I'm assuming you all have that you all have an SIP, right? You put SIP, it goes to mutual fund, it goes there. Now the money doesn't go out of the banking system. The money is always there within the banking system, that the banks continue to get this money back to them. It's just that the character of the deposit changes, the nature. Earlier it was a savings deposit, now it is an institutional deposit. And now that institutional deposit can go at any point in time. You have no control over that, right? So for example, if we are worried about mutual fund, then we just withdraw the money, then the mutual fund just takes it out, right? So you don't have a good control over it, right? So that is increasingly happening. So that means the banks, the total deposit that is there is essentially which was around 45% was what you call as current and savings account deposit. That has fallen to about 35% now. Okay. And what does that do? You see the left hand chart, essentially the bank's marginal cost of funds go up. Okay. Simply their cost of funds go up, right? Now, if you are a bank and you are a commercial entity, so you have to make profits. The typical measure for a bank is net interest margin. How much interest I pay, how much interest I receive. Okay. If you're paying more and more on interest, obviously you have to, if I have to maintain the net interest margin, then I have to lend at a higher rate. If you are going to lend at a higher rate, you cannot lend it to a good quality customer, because he will say that I'm not going to accept your higher rate. So what the banks will do, they are increasingly lending to medium and small enterprises, relatively okay because it creates employment, but they are also increasingly lending to retail customers, right? Now that's a problem. So you can think about this thing. I came yesterday and I just went to the Lulu Mall yesterday, and this I keep observing in every mall and places like that, and I keep looking at how many people carry an iPhone Pro Max in their hand, right? And I find amazing that so many Indian youngsters have an iPhone Pro Max in their hand. It is such a costly phone to have, right? And with the price of the Apple phone has just been increased. The fact is, why is it happening? It's happening because you can borrow, right? So for example, if you had gone to a Chroma or somewhere thinking that I will buy a 42-inch TV, you might come out with a 65-inch TV. Simple logic, because when you walk in, he will say that EMI, buy now, pay later, right? And I don't know whether I told you this last time, a couple of years back when we were researching for the FSR, we found that in Pune, the buy now, pay later has become marry now, pay later. Okay. So the simple logic is because there's a lot of people who wants to have destination weddings, right? You want to go to Seychelles, you want to go to somewhere in Tuscany or whatever it is. The NBFC comes in, tells, marry now, pay me later. I'll give you the money, right? So this is the kind of system that you're coming in, right? And then what happens is the aspirations goes up. You become a consumption economy. Everybody wants to have a better way of living, but it is way beyond their means. But that is not a good system to have, right? So we continue to look at these things. So far, we haven't found too many issues as such because we need to continue to dig, because what happens is these guys are all good because to pay off one loan, they will take another loan, okay, what you call as evergreening. So these kind of activities happen. So it is a very difficult job to find that, okay, and exceedingly extract that information. But this is one of the issues that we need to be worried about. So this is the last chart on the right is where the net interest margins are falling, right? What I'm trying to say. The MSME sector is growing. It is a good thing because they are the largest employers in the economy. We need to continue to grow, but we need to see that the micro enterprises, any place where there is abnormal growth, it is always an issue for us, right? If they are growing at a normal percent, it is fine, but suddenly somebody growing out of whack, then it creates an issue for us down the line. NBFC sector is relatively okay as of now. The other issue that I briefly wanted to touch upon is on the consumer credit, right? And increasingly, I'm in the land where everybody likes gold, right? So gold loans have significantly gone up. Now, gold loan has become the second largest retail loan category after housing loans, okay? Now, there are two ways to look at it. One, you need not be significantly worried about gold loans because gold is treated as a good collateral in the Indian context, right? Everybody accepts gold. So you are willing to do it. But quite a lot of the gold loan this time has increased primarily because the gold prices have gone up massively, right? Now it was about $5,300 and it has come to less than $4,000. I don't know what is the Indian rate for that, what are the jewelry, this thing, but you can imagine what is the cost, right? So you can see on the second chart, the dotted line is the price increase, right? That is the 235 from, if I normalize from 100, it is about 235, right? And then you look at the NBFC's growth, which is essentially our guys, Manappuram and Muthoot, right? This is the value terms. Okay, so this is just growing massively, right? And so now I need not worry significantly, as I said, because gold is a good collateral and this thing. When this happens, so for example, one of the ways that the Reserve Bank and every other regulator deals with these things is, if you want to take a loan, we normally we cap something called loan to value ratio. Okay, so we say that you can give only 75% of value as loan. Okay, as long as the gold prices keep going up, that loan to value ratio keeps falling. So the banks have more cushion to probably lend. That is fine as long as the gold prices are going up. But the moment the gold prices fall, then the loan to value ratio simply goes up, right? Now, the other issue with gold loans is that what we looked at was that we find that quite a lot of the people are using gold loans to repay other loans. Okay. So because for the same tonnage of gold that you put in over there, now you get a higher amount. I take that, I repay some of the other loans, okay, and then I consume, right? Now, why are more people taking loan? Is it a sign of distress, okay? Or is it something that they see, okay, I have an asset with me and using that asset I can borrow and I can do it. Now, ideally, if it is for an asset creation purpose, we have no problem. The moment it becomes for consumption, then it is not a good way to proceed. Yeah. Meaning what? So all these loans are gold backed, right? Yeah. These are all gold backed loans. So essentially yeah. So this is essentially people pledge the gold. Okay. Yeah. So it is essentially you just go to the bank, you give the gold to them, and against that you get a loan. Okay. So what you are seeing is that. So what you are seeing increasingly NBFCs are absolutely, I mean, and that is driven by our own 4 guys in Kerala, right? They are so, and I'm sure that their CEOs must be flying left, right, and center and making a lot of money on this. But the bottom line is that's what it is, right? So
24 hours.
yeah, I mean, obviously,
Open 24
yeah,
hours.
yeah, absolutely. Yeah, exactly.
24 hours gold loan.
So exactly. So this is something that we are continuing to look at. So far, it hasn't become a problem. But any time when these any loan that you are taking and it is driven for consumption, at some point in time, it is going to create a problem down the line, right? Because you're not creating an asset. So everywhere, all over the world, I mean, most of the other places, what happens is quite a lot of the retail loans is towards housing, right? Housing loans are fine because typically you have a house, right? You're and then what has happened over the last 1.5 years is gold has become an extremely volatile asset. Previously, I mean, if you look at gold prices, it was never used to be like this, right? Just going up massively, coming down massively, never used to. Everybody used to think that gold is a good hedge against inflation. These were the typical things that we were told, and quite a lot has changed because one thing that is happening is central banks are increasingly buying gold to diversify their reserves away from dollar. So the demand for gold has significantly gone up, okay, including Reserve Bank of India. We bought a large amount of tons, almost 1,000 tons of gold is there with us now, right? So you're just diversifying away from dollar. Because why? Because what US has done to Russia, what if they do to somebody else? Okay, they just say that all the accounts are in the US, they just freeze it, that the reserves are no longer available to you, right? So Russia has no access to almost $600 billion of reserve. Okay, it's frozen by US, right? So then you essentially look at this, okay, how do I diversify away, right? So gold. So the demand for gold has gone up, and the gold is becoming increasingly a very volatile asset. And that is not exactly the case with housing, right? So the housing is something that happens, but this is something that we need to be worried about. And related to that is the household debt, right? So household debt is about 45.5% of GDP right now. Now, compared to quite a lot of the other emerging economies, it is still relatively low. While that is okay, the distribution of the loan is what is worrying us, right? Because if you are taking more housing loans, within that and household debt is going up, it is relatively okay. But if you are taking unsecured loans to buy a big TV or a refrigerator or a phone or these kind of things, or you're using gold loans and then consumption, the other thing that we often hear is that a lot of people take a lot of loan for vacation, right? It has become such a massive thing. Yeah, exactly. Everybody, and then that is a bad thing for us in massively, because you're taking the money out of here and you're going and spending there. So
All the LTCs
yeah, exactly. So for example, when I joined the Reserve Bank of India back in 2000, and then if we say LTC, we think about, okay, if I'm in Kerala, I'll think about going to the north, right? The young generation which is now coming in, I hear that they are either in Paris or somewhere in Italy or those kind of things, right? That is the world. So that means enormous amount of capital that is moving out. And but again, quite a lot of it is out of borrowings, right? And then that is going to create a problem. Now, so how do you assess this? There are two ways to look at. One way we look at is what is the rating of the borrower. So we all have something called a CIBIL score, right? So we look at, okay, what is the CIBIL score? You are a prime customer or you are a below prime customer. Most of the borrowers are above prime. Now, the problem with that particular, just taking as it is the problem is we are not sure that they are taking money from somewhere else and repaying the loan, or the entity itself is giving a loan to repay the previous loan so that your CIBIL score remains high. Okay, that is one challenge we have, but that is the data we have. This time, for the first time, what we did was we did a survey with our banks and some of the NBFCs, asking at what level of income are you giving loans? Okay, and what we found was that most of the loans are going to people with income below 10 lakhs. Okay, so these are not significantly large income group, high income group. Large amount of money is going to people with below 10 lakh income, and that means that is something that we need to continue to monitor, because that effectively means that if you are continuing to borrow and if the wages are going to remain stagnant for them, it is going to be a problem, right? And for us, quite a lot of those problems are going to happen. Especially one of our crowning jewels for a long period of time was the software industry, right? With artificial intelligence coming in, software as a service is absolutely looking, we don't know what exactly is going to happen. And that means if they go under, there is a lot of problems, because if you go to places like Bangalore and all, the city developed because of that, right? Your income grows, your requirement for a house, then the rent goes up, the maid's income goes up, so on and so forth. It's just a cumulative impact, right? When it goes down, it is going to have a problem. So this is something that we have to continue to look at. As of now, we don't have data point to say it's a massive problem, but it is something that we are going to continue to dig deeper to get a better sense of these things. The other thing that we did was we did a survey with the bankers, asking them what is the biggest risk, cyber risk that they are looking at, and everybody agreed that it is the artificial intelligence related risk, right? So you probably would have heard about a program called Mythos by Anthropic, okay, which was taken out because what's happening is that these artificial intelligence things can create malware to essentially come around the existing all the guardrails and essentially create a lot of problem. So they are good, but they can be equally bad, right? People can because everything is quite a lot is open source. So you develop on that and you create, cyber threats are increasingly going up. So it is something that we need to be worried about going forward, how we are going to deal with that. The last two slides, and I'll stop, is essentially we do something called a stress test because we have to know that, okay, if a stress event is going to happen, can our institution continue to survive? That we continue to look at. So we made two assumptions this time. One is the intensification of geopolitical risk because the war was going on, right? So one assumption is that, okay, the war stops and the economy goes back, or the other one is it's a lingering conflict. It goes on for some time. So in one assumption, you can see that the inflation is essentially, it comes down from whatever, what is it? This is, sorry, the GDP. The GDP comes down from 7.7, right? It comes down to 3.6, then goes up to 3.8. That means it's a 1 year problem. Next year, you're going back up because we make a 2 year projection. The other assumption is that it is lingering. Then that means it has to come down 3.1 to 2.4. These are hypothetical scenarios. The second chart is about inflation. So similarly, if the crisis, if it is going to linger for long, then the inflation is going to stay at a higher level for long, right? Now, the simple logic from that is this: if the inflation is going to remain higher, then the central bank's primary responsibility is price stability, and that means you have to increase the interest rate. If you increase the interest rate, the likelihood of borrower default goes up. As the likelihood of borrower default goes up, the banks have to make more provisions. If the banks have to make more provisions, then their earnings will come down. If their earnings comes down, their capital will come down. Simple. This is how you arrive at, right? Obviously, we have a model to run all these simulations and things like that, but this is broadly what we do. But the good part for us is that even under severe stress, we think that the bank's capital will come down to about 13%. That is still about 2.5 percentage points above the regulatory minimum. Okay, so they still have adequate capital. So we need not worry about the banking system as such. We do a bunch of stress tests for non-banking finance companies, and we do it urban cooperative banks. I didn't want to bore you with all those things, but broadly, the good part of the story is that, okay, your banking system remains relatively good, which is a source of strength for us. But we have a lot of macroeconomic vulnerabilities right now. And that means it will take a longer time. That the only, I mean, your easy panacea for quite a lot of that is to grow faster. And that means ease of doing business has to increase. You have to attract more capital and things like that. And that means reforms more. But none of those is Reserve Bank's job. Reserve Bank of India's job is to ensure stability in the system. And then we have to act if we see that either the price stability or the financial stability is impacted, then we have to act on it. So that's about it. That's my presentation. Thank you.
Yes, thank you, Mr. Ivan Nair. It was an outstanding presentation. I will start with, I am not going to I think we have two designated people, so I should not be speaking, but I'm tempted to speak because you are too provocative. And first suggestion is that the report is going to be will have to be renamed next year onwards, financial instability report rather than stability report. You know. So, okay, I think your articulation from the global geopolitical context that influences India's macroeconomic landscape and that how that get translated into India's economic performance. That's actually very well articulated, wherein you rightly said that you are in a kind of dilemma to predict what it is.
Yeah.
But everything said and done. The world that we are, I'll take it 2 minutes. Uh, I'm tempted not to speak, but the world that we have inherited from the last 40 years of neoliberal reforms is not only more unequal, and undoubtedly it is going to be more unsustainable. And this instability is going to be a part and parcel of the economic life that we are going to face with. That I think that has to be taken into granted. Particularly today, we are living in a notwithstanding the multilateral institutions that we have nurtured with huge effort. They have been shamelessly remaining as passive spectators. And today, anyone can wage a war, be it Ukraine, be it anywhere. Nobody asks what happened in Venezuela, nothing asked. So the point is that the world that we are going to live in, unless and until, this actually literally very vital question as to why India, China keeping us. I mean, I'm actually, it's a very different topic. But this is where the countries in the global south has an important role to play, wherein, in fact, where is India? India is a so-called democratic country, at least, no more democracy. I don't think that as academicians we are as free as we used to be to write. We are not. I mean, I'm not, that's a fact. But at least we are, everything said and done, we are just democracy. And what India and China, if they can indeed join together, everything said and done between these two countries, not even a single gunshot happened after 62. But so I think there is an important role that India and China can play in resolving this and re-articulating and coming up with a new set of global multilateral organizations to address this problem. Until then, we'll have to live with that. I think when you are coming into the domestic aspect of it, I was very. I remember when I used to be a student, I used to have saving. When my children came, 500 rupees given, it is gone. 1,000 rupees given, it is gone. Not a single rupee saving. They don't know what is saving at all. And Rangarajan and Srivastava articulated that. Now you are seeing that the way in which the banks, the saving to the savings, the way in which we passive savers, in fact, and that money is now going more to the new generation, to equity market. What is going to happen to banks? And it is important to ask. I was recently, my manager came to my room. I told her, I don't want any FD. I have no FD. I have no FD. It's in real terms, the FD I get is negative return, in fact. And in fact, today it is important to articulate what the banking system can learn from the Kairesu system of Japan. The bank's job is not just to give loan and in this context, the way in which their own money is going away. And they should be you should be thinking in terms of a new system, new form and content of banking system, which I would like to take the so-called Kairesu system in Japan. You must be aware, wherein banks are not passive money givers, active participant in the whole process. So banks has to be much more competent in terms of deciding. Today they evaluate the thing. So as far as we are concerned, from this institute, I would say that some of the important aspects of the center-state financial relations, the manner in which a country like ours, wherein states take the heavy lifting, 62% of the total expenditure, and they're having revenue entitlement only 37%. And in that context, when we are having a restrictions, which as I rightly said, FRBM kind of restrictions on the states borrowing, states have so much of restrictions, but private sector no. You think about private sector borrowing abroad. Say, for example, in terms of money raising by how much restrictions RBI puts on private sector. But the state governments are having numerous restrictions. And all the more importantly, when the savings, when the spending goes up like this and financial household saving declines, the whole calculus on which our FRBM framework is articulated, saying that 10.11% was the household financial savings at the time when Rangarajan and Srivastava articulated. Today it is 7%. And we are living still with that. We are still with FRBM 3%. So and I think one point which I thought you have perhaps missed is the particularly today when we are talking about our merchandise trade deficit. Trade deficit we may be having today what 300, 400, and it is almost offset by trading services, mostly by remittance and our software. As you rightly identified, with AI coming in, when the software is going to be doomed, what is going to happen to our today we are actually surviving on our current account foreign exchange reserve. Our current account deficit is negligible because of these services, and particularly software. And what is going to happen to that external stability which software has given? Software means basically IT coolies has given. That is an important question. In fact, you had a survey. RBI has done a survey of software companies on this matter. I think that is also an important issue one can perhaps bring in. So I think very interesting and very, very, very illuminating report. Thank you very much. And I think we have learned people here, prepared people. I just listened to you, in fact. So thank you very much. And I would like to invite Professor Bhanumurthy for his feedback on the report.
Yeah, can I?
To you.
Can you hear me?
Very much.
Yeah, so first of all, let me thank GIFT for inviting me to this presentation by the Reserve Bank of India. It's the latest report on financial stability. And I think we must congratulate Sri Ayappan Nair for his presentation, very, very detailed presentation on many of the very difficult topics. In fact, I was a little hesitant to accept this invitation, but then I thought I should also learn what exactly is there in the financial stability report. So to that extent, it was only a learning experience for me. But then I thought Mr. Nair was a little more different from the central bankers. In fact, there are some of the statements which he made today. I think it's actually generally the central bankers don't make. One of the statements he made was that RBI buying gold to replace the US dollar. I think these are some of the statements. It doesn't really normally come from the central bankers. And I think I am very glad that he was very candid enough to make this presentation. Coming to the report itself, as I said, it was a very difficult and tough report for a general economics students like us. But then I tried my best to understand the first chapter, and it's actually not very different from other RBI reports. I'm sure many of the participants, those who are here, they know that I'm a big fan of Reserve Bank of India. So I think in that sense, this report actually shows the kind of research, rigorous research that the central bank undertakes to some of the difficult, issues that Indian economy is facing. But then a report like this, generally it's more of a stock-taking report, right? And this is what the report is actually doing. But at the same time, in fact, I was remembering one of the statements by Dr. Y.V. Reddy, as a very distinguished central banker. He used to say that in the financial markets, yesterday is not an indication of today. I think that actually summarizes whatever is there in the report can become less useful for tomorrow. I think that is exactly what's happening, as the report clearly mentions. This whole information that has in the report is based on up to the June 10, 2026. But then since then, we have seen so much of action happening in the financial world. Be that as it may, but the kind of the structure, the kind of rigor that report has, I think it is a must read for all students of economics and finance. And we also have to remember another statement by Governor Shaktikant Das, who made some couple of years ago, that the world is actually in that what we call is as a VUCA world, right? VUCA, VUCA world, where volatility, uncertainty, complexity, and ambiguity are the characters that we have right now. Given that kind of a situation, assessing the financial markets and also talking about what would be the risk going forward is extremely difficult. As I said, I think this is really very important to be kept in mind, particularly when we read this report. But another way, I mean, usually I don't agree with Professor Joseph, but then today in couple of places I might agree with him. But where I don't agree is also important. You can write this kind of a report only when you have when you have fiscal and monetary stability. I think there is not much of general appreciation how the financial sector is also related to fiscal as well as the monetary sector. So the financial sector's stability is highly dependent on the kind of fiscal monetary coordination that any country can have. So if you look at the last 3-4 years, where we had what we call a classic textbook fiscal and monetary coordination, I think that is one thing which has actually helped us in overcoming many of these uncertainties and volatilities that the world is facing. And I think this is also tribute to both RBI as well as the finance ministry for streamlining the whole overall macroeconomic stability. So the financial stability and price stability, I think that's a whole lot of literature. And I think the causation is actually bidirectional. So this is one reason why we do see that a perfect coordination between financial and price stability in the country. So that is to some extent is visible in the report. But when it comes to the current global and domestic situation, Mr. Nair, you already raised it with regard to FCNRB as well as other RBI policies. My own sense is that for the past 5-6 years, the way the world economy is actually shaping up, I think you are going to see some kind of a reverse globalization. We have already seen that the way tariff wars is happening, the way restrictions on the capital flows and the restrictions on the labor movement also. Given that kind of a situation, I think it's also very important for the central bank to focus on domestic savings. You said that FCNRB is a good measure for foreign savings. I thought if you want to really ensure the domestic macro stability, I think it's also important to focus on how we can incentivize the domestic savings. And this is where I agree with Dr. Joseph. When the household savings actually declines from 11% to 7%, how do we going to achieve the kind of investment rates that you need for achieving what we call Vikasit Bharat? So I was looking at if there's any story in the report on the domestic savings. There was only one place I saw, the savings has been referred, and that too on that old age savings. I think that is where I've seen it, but otherwise I don't see there is any coverage on the domestic savings per se. But then um, I thought this kind of report should also come out with some kind of early warnings. You also referred to FCNRB experience in 2013. Now, are we going to have a similar kind of experience going forward? Is something that even we economists we would like to know whether we are going to face a similar kind of situation that India faced. In fact, the then governor clearly mentioned that he did not want to go for FCNRB in 2013, but then he was being forced on him. It was being forced on him. So, and I think we faced its own challenges when those deposits were maturing. And there is another issue which I thought the report should have brought in. RBI short dollar position. I mean, again, yesterday or today, I've been looking at the newspaper. I think there's a huge challenge for the Reserve Bank of India and also for the forex markets. How you are going to, release that almost like $100 billion, which is being almost like a rollover that has been happening for the past 2 years under the short dollar position of the Reserve Bank of India. So I think these are some of the risks that the financial markets are actually looking at a little more carefully. But otherwise, as I said, I've really learned a lot from the report. But then there are a couple of places I thought, there are some kind of clarity that is needed. In fact, I was looking at usually the overview chapter will have much more detail than what it is right now. And you have almost 160 pages report, but then the overview is just about 1.5 page. So I was not getting much from that overview. So maybe next report you should have a slightly longer overview, and also there should be some summary in each chapter so that, once we read that and we can go back to the main chapter. So I think in that sense, it needs little more restructuring when it comes to reporting. The other thing is there is one statement in the report. It says that the growth of NBFC is due to tightly regulated banking. I think this needs little more elaboration. Are we saying that the regulation on the banking sector really tight? And if at all it is really tight, why should it be really tight? Or is that a right size of regulation? We really don't know whether or is that because you want to encourage the NBFCs, you are actually regulating the banking sector much more than it is necessary? I thought that particular sentence was really catchy. So that needs little more explanation. And when it comes to external sector also, there are, the report takes up many simulations. Then in one of the graphs, I think that is 1.17b, where you talk about different levels of CAD. And he says that event 1, event 2, event 3, event 4, but it is not specified what are those events. Maybe I missed it out, I don't know. But I think in the report, it doesn't clearly show what exactly this event 1, event 2, event 3, and event 4. Then and even in your presentation, you said that banking sector is actually moving more towards the MSME sector and retail lending. Again, is that because of the demand constraint in other sectors, or is that a focused policy of the Reserve Bank of India or the banking sector? Why is this banking sector moving towards MSME sector? Of course, it is required. I'm not denying that we should not, but particularly when you see that the NPA is very high in the MSME sector, why is the banking sector actually increasingly moving towards MSME sector? So that is another area where I think we need to have some kind of clarity. I think when it comes to the Indian banking sector resilience, there is one graph I forgot, I think in page 32, where you say that funding is a problem. I think this is exactly what we have been arguing for a very long time. Liquidity is a major problem right now in the Indian banking sector. And I think it's shown up in another graph also where the liquidity becomes a major constraint. And is that the reason why we see that bond yields are much higher than WACR, or is that the reason, or is that because of the capital flight that we are seeing, particularly in the capital account? I think that again needs some kind of a in-depth assessment. So, and generally we thought about inverse relation between CASA deposits and the monetary policy cycle. Now, one of the graphs, I think in the graph number 1.40a, you show that there is no more, inverse relationship. I mean, again, this is again, we want to understand why is that, what exactly driving the change in the relationship between the CASA deposits as well as the interest rate cycle. So there are other issues. Suddenly, we do see that credit to microfinance sector is increasing. Again, I mean, there's not much of discussion in that, but then we want to know what are the risks in increasing credit to microfinance sector. But if you look at the history, it doesn't really have a great history. So we just wanted to know whether increasing credit to microfinance sector will have any implications. I think in graph 1.51b, NBFC sector, if you look at the efficiency component, it clearly shows that that is a concern. But at the same time, the report argues that it's happy that there is a growth of NBFC sector at the cost of banking sector. So again, it is not actually supporting those arguments. Household sector debt. This is the report says it is actually increasing, but it doesn't show any kind of alarming kind of a situation. But then I also found that the definition of housing loans. In fact, in the graph, the housing loan also includes vehicle loans and two-wheeler loans. This actually, I think, it's slightly misleading. Why should housing loan include vehicle loans as well as two-wheeler loans? At least, particularly, I looked at the definition in the footnote. So it says that housing loan includes vehicle loans as well as two-wheeler loans. So these are some of the comments that I have in the report. Of course, the report clearly brings out, yes, the risk coming from the AI related investments, and also talk about the Indian financial system is in a much better position. So these are all good news, but I think we want to understand what are the early warnings that is coming out from the report. Particularly when there are a lot of stress on the fiscal going forward. Particularly, we have seen how the governments are absorbing the international oil price shocks, both state government as well as central government. And you also showed somewhere that central banks are reducing the balance sheets. So going forward, it would have huge pressure on fiscal accounts. I think these are some of the things I thought we need to discuss a little more going forward. Not necessarily in the report, but I think since a lot of PhD students are there, I thought I'll raise some of those issues for further discussion and research. So let me stop here and again congratulate the Reserve Bank of India and Mr. Nair for this support, for this presentation. And thank you so much, Professor Joseph, for inviting me to this presentation. Thank you.
Yeah, thank you very much, Professor Banimurthy. I think that was a very candid discussion. Your affinity and association and expectation from RBI was very much highlighted. And I know that as a director, you wanted to do a quick job by looking at the executive summary. You couldn't do. I also felt the same thing. I think you had to do the hard work, which you did. We appreciate very much that. And I think the most important recommendation from your comment is that you should have more detail, slightly more detail, not another. So I think, thank you very much. We are so happy that you took our invitation and put in the effort required to comment on the report in such a detailed manner. Otherwise, normally professors and directors normally say good words and say hello, very good, and all. But thank you very much. So I think
can I respond?
So you meant to say I'm not a director, right?
no, that's it. We are, there is no, we are all not directors. We are all directed. I think we have Dr. Anub as well, so that
Okay.
after that we can respond.
Okay. Okay.
You are brief.
Good afternoon, everyone, and good afternoon, Dr. Bhanamurthy. So, most of the points I wanted to discuss were covered by Professor Bhanamurthy. So, I'll raise some points that it's not related to its comment. So, from when I went through this report, it shows that the system is more or less resilient. That is the overall message. But the tone of the report is very much reassuring. Can we go by that level of reassurance is my question. I just went through again quick glance. So banking sector, I looked at the NPA. At the headline level, these numbers are good. This GN gross NPA ratio is say very as low as maybe last decade 1.8 and CRR is around 17.5. These numbers are very good. But my question is how much of this NPA comes from say genuine resolution versus the denominator driven? We could look into say decompose it into say resolution, recovery, upgradation, and all those specific segments. The report mentions it, but could have gone a bit deeper. So it's there. And again, I looked at the stress test. This is something that I'm personally interested in. Again, overall the numbers, even under severe scenario CRIR, it comes down by almost 4%. And the system is below the regulatory minimum, again, which is good. But again, 4 banks are holding this 12% of total, say, CB assets. That if we apply a shock there, that's one concern. And again, the severe scenario assumes GDP at say 2.4% and CP at say, I think 7.7%. It's kind of a stagflationary combination. And again, do the models capture the joint tail risk? If we say simultaneous shocks. So that is something I could not get a clarification on. And gold loan, again, we have discussed in detail, so I'm not going to get into that. Same with the household debt. As you have raised this AI, I want to flag a different concern. I am working on this thing for the last couple of months. So I was just kind of sandboxing, kind of testing some of the AI as a loan agent. There is a lot of implicit bias when this AI is acting as a loan agent, screening the application. So from what I understand, the current RBI regulation, they say some regulatory sandboxing, but do we have some proper audit mechanisms to validate these models? Because for the time being, it's a black box. You give a loan application, they reject it, especially private and MDFC. We don't know what's happening. How they are coming at the reject decision, we don't know. Because whatever models they are taking, especially if they're close-weighted models like ChatGPT or anything, you don't know what the training weights are. So how do we take care of that angle is because I think in the future, mostly these models, they will be going by an AI-based screening. And especially when you don't have standard credit score available, you will be looking for these proxies. How you will be penalizing these proxies? It's not in the report, but as you were repeatedly mentioning AI, I thought I'd raise this. And the interconnectedness, again, the analysis, if could have gone in a dynamic way. If we consider the time varying dimension, that would be good. And yes, I mean, these are the points that I wanted to raise because all the other points were already discussed. So thank you.
Yeah, thank you, Dr. Anu. I think that was a highly complimentary to what Professor Banimurthy raised. So I think you may have a quick response, then
Yeah.
I'm sure.
Yeah, okay. Yeah, so first of all, many thanks to Dr. Banamurthy for reading the report. I mean, so part of the reason why we keep the overview small is so that people read the report. I mean, jokes apart. So one of the challenges is, see, we want to say many things, but are we a mature enough economy and market where you can articulate all these things? Quite often, one of the challenges as a policymaker you face is that how much to tell and how to tell. So what one strategy we have adopted, at least for the learned people, is that you connect the dots through the charts. We try to keep the charts and rather than put out the message as such. Because if we write saying that the savings rate is a major problem, the next day the headline will be RBI says, right? So, exactly. And these are extremely challenging things. Unfortunately, we have not reached that mature stage where we as Reserve Bank of India has the confidence to say some of these things. Even then, at our level, when we write the report, we try to put quite a lot of the things as much as possible to our top management. But then again, it is above my pay grade. And then essentially the governor has to decide what should be the way it should be articulated. So that is one of the biggest challenges in terms of communicating, because it is the only report out there which is supposed to highlight the risk. Right. And when I highlight the risk, how much to highlight it, how much to keep it with myself, not that we are not aware of, but can we keep it within our system so that we only discuss with the policymakers and then discuss about that. That is one of the biggest challenges we have. On some of the things, I think the even 1 and 2 and all those things, the footnote has what are those events we have clearly mentioned on the current account deficits that you have said. On the NBFI bank, it is not the NBFC bank, the NBFI bank, which I mentioned in the global part, is that so increasingly what happened after the global financial crisis is that banks have been increasingly more tightly regulated. And that is perfectly required because banking is a business of trust. Banking is a place where only the public deposit is available, right? Non-bank financial intermediaries don't have any deposits as such. They borrow. So banks are increasingly regulated. There is more close scrutiny on them. Naturally, then that will leave the money to be fungible because it will move to the least regulated area. So it is just a byproduct of what has happened because you thought that you can keep the core of the system stable. Then the periphery, something happens, the core won't matter much. But what is increasingly happening is the core and the periphery is getting largely interconnected. So something happens in the periphery, it can affect the core. So that is going to be a growing challenge for the system as such. On the fiscal, extremely difficult for RBI to write something. So even if we write, it will be cut off. Because to be honest, because you don't want, for example, a central bank saying that, okay, there are fiscal problems emanating. So some of the things we argue is on through the bond market, what happens, right? So quite often, sir, the classic Hindi dialogue of "Samajhne wale ko ishara kafi hai." That's what we adopt, right? I mean, because you want to say, but you can't say out in so many words. So quite a lot of those things are that. The early warnings, again, what we try to say is that, so for example, when I say there is a funding challenge for the banks, I can only say that much. I can't go back and say that, okay, this is going to result more problem for the banking system or things like that. Because we are, unfortunately, we haven't reached that level where neither do we write through reports or neither we have people coming out and being honest about it and talking about it, right? So, for example, you asked about the FCNRB deposit. In my opinion, FCNRB deposit is like a Brahmastra. I mean, it is such a precarious situation in which you are doing it, right? So it is not a good sign for you that you are relying on FCNRB deposit because you are short of capital. So that's a challenge that you are going to have. So, but can you go out and say that, okay, the FCNRB deposit is a problem, right? then it creates its own stress. So often one of the things that I tend to say is that sometimes when we do the stress testing itself should not cause stress, right? So we need to be careful in because I would love to what you say in a closed door environment have these debates and have articulate all these things, but putting it out in the report is a real challenge for us. I mean, given the stage of our development, especially given the kind of media that we have. The number of times after the report comes out, we have to go back and correct some of the reporting is far too many, because they just pick out some number from here and there, and because they want to sensationalize something, right? So when they can't find too many things about what we are saying. So previously what used to happen was that stress testing result was at the beginning. So the friend public next day when you open the paper, the first thing this thing RBI says that the NPA will go to 10%. This is the number they will say. So now we don't put out the number first, and then we clearly say these are hypothetical adverse scenarios, not that it is going to happen. They are plausible, right? So that is the real challenge, sir. I mean, so quite a lot of these issues we are aware of, we internally discuss and debate, but how much to put out there in terms of, and the size of the report is, so in fact, you read the first chapter, that is where most of the risks that we identify. The second chapter, we do the stress test. Because it's a report of the subcommittee of the FSDC, there are all other regulators. Now, only Reserve Bank of India has a prudential focus. That means the risk to the macro system, right? Because the other all regulators are conduct regulators. That meaning if I have bought an insurance policy, if I have invested in equity, those kind of things. But they are increasingly using FSR as a place for them to highlight their achievements. So the third chapter, which is all about whatever circulars they have issued, whatever regulatory measures they have taken, that is now taking the sizable chunk of this. Okay, so the report is, if I strip off that, the report will be probably less than 100 pages, maybe about 70, 80 pages. Half of it is coming from there. So these are challenges that probably you would have experienced in your dealings with the policy makers, some of those things. But within those constraints, we are trying our level best to provide as much information as possible. But those are some of the challenges that we continue to face. You asked Dr. Anup on the NPA. I can very well say that NPA is not a problem. It is not, so we provide the numbers for what is upgradation, what is recovery, what is write-off, and things like that. So it is there in chapter 2. If you get the numbers, we clearly say where the NPA reduction is happening from, and an NPA is not a problem for us. On the AI part that you said, we have recently issued a guideline on what is the model risk management that the bank, every entity should have, which is a very detailed this thing. It's a draft guideline where we are seeking comments from public. I think that will address some of the issues, but it is an evolving area. We cannot stop the banks from not using it, but we are going to learn, right? I think some of the things like the hallucination associated with the AI concept where they have an implicit bias, and those things are going to evolve, and which we have to do it. But that is going to happen. So my limited point is that, I mean, within this, so for example, I'm happy that you said that I've been candid and say certain things, but that is the whole objective of these outreach activities is to tell what is not exactly out there in the report, right? Because you cannot just forthright say quite a lot of the things in this thing. So probably if you tomorrow write an article saying that the savings is a problem, then tomorrow, the next day, somebody will sensationalize. Professor Bhanumurthy from Madras School of Economics says that India has a major savings problem, right? But at an individual level, that might be okay, but at an institution level, it often becomes problem, right? So those are some of the challenges that you face. You ideally want it to be as forthright as possible and address some of those challenges, but there are constraints. There are constraints in terms of how much to communicate. Not that we are not aware of some of those issues. We work with the government. I think one of the important points that you said, and which is vital, is that over the last 3-4 years, the fiscal monetary coordination has been tremendous. I think quite a lot of the price stability is achieved because of that coordination, because we cannot, I mean, Reserve Bank cannot take care of price stability if the government is not on board, because most of the price related is supply side issues. And they understand that, and that has really worked well. And I completely agree with you that has been a phenomenal achievement over the last 3-4 years that has happened. That was missing in the previous, when a couple of previous governors were around. That is a good point. But as I said, some of the things it's so fluid that you cannot say out. You know that the exchange rate is depreciating, but you still want to create a narrative to say that, okay, it is depreciated, but it is still under control, right? So it is always the tussle is about financial stability report is, I say, through the chart, there's a problem here, there's a problem here. Then finally, I say everything is fine. Right? I mean, so how do you communicate? It's an ongoing challenge. But at least one of the efforts that we are making is trying to make it simple for people to understand. Because the challenge of the report is quite a lot of it is technical. And quite a lot of those things are not easy to communicate. But I take all those feedback with me, and then we will try to continue to improve that. So thank you so much for all those feedbacks from both of you.
Yeah, okay. I think we'll have a few. It's already 5:15. We can have a few questions and yeah, few questions.
They're all tired, I guess.
Okay. Kiran, yeah, start. Okay. He's the person most worried about coordination,
Oh, is it?
fiscal monetary policy.
Okay.
So, to be very honest, that FSR report can be some sort of described as a situation that provides a reassurance contingent upon a hopeful moderation in favor of India. That's the one thing, because every challenge that says it may happen to be in favor of country, that the moderation will be happening in favor of all the challenges that we are facing. So accordingly, everything will be solved out, and then as per that we can be say we are resilient or some sort of that. But in the case that, for example, the specifically you have mentioned about the continuous decline in the FDI as well as the FII inflow. So for a longer period of time, even when we were having a significantly higher current account deficit, even though we have contained it, more or less it has been financed by the particularly the inflows. But in case where the global conditions are actually providing more challenges, that is certainly ensuring that your current account deficit is going up. Then you are having a situation, the inflow is also going down. So the way by which you used to finance the current account deficit is going down. So the earlier works pertaining to the twin deficit aspect, where the fiscal deficit causes the current account deficit and back. So across India, the evidence that there is only one unidirectional causality from fiscal deficit to current account deficit, but not the other way, because current account deficit got financed by the inflows itself. But that particular situation is getting challenged. So in that particular case, the same vicious cycle that you have mentioned may again comes in, because the whole case of deteriorating fiscal deficit, the current account deficit can create more sustained pressure, even if we are not able to, some sort of strategically converting the entire structural factor of the Indian economy in favor. Because as we say, AI, the outflow may be caused more by the AI advantage, but creating an ecosystem that will be favoring in the advancement of AI itself is not a short-time magical process, or it may not comes out of a simple policy announcement. So it takes even more hour. And again, the same thing that you have stated, until and unless Trump exists, we cannot say what is going to happen next. So all the particular hopeful moderations in future is also contingent upon how long Mr. Trump will be holding the office. So that's the one thing. Second thing that you have mentioned about the debt swap, like we maintain a weighted average maturity of the debt for almost a decade, like 13, 14 year is what the maturity profile. But again, what happens is we are swapping the debt, like for the short-term maturity, when it is getting matured, we swap it with the long-term debt. But what happens is, in a situation of global challenges where the risk premium is higher, the yield is going up, what happens is you are creating more and more interest rate pressure, because the inflation is high. So in that situation, the central bank cannot sit idle. It should respond by some sort of interest rate demand. So when that interest rate changes is happening, then that will again further increases the demand for the premium. So again, that the interest expenditure already cost almost 1/4 of the total expenditure of the government. So that may be going up. So how come that will be conditioned as a situation that it will be it will ensure a favorable debt dynamics, because the whole aspect of inflation, the fiscal sustainability, all these are interrelated. So if you are having one side which is absolutely deteriorating, then how come you can ensure the other side? Because some sort of adjustments should be happening. And again, that particular one statement that state government is going crazy and the central government has continuously reduced the bank backing of the debt, that is absolutely wrong, because that one source of bank has changed. Like for the bank share of securities has gone down from 44 to 38, 36 from the 2014. At the same time, the holding of the insurance companies for the government securities has increased from 19 to 26%. Hmm? No, I am. No, it is from the RBI. It's, yeah. Oh,
Central government security holding across banks, pension funds, insurance companies, everywhere it is.
yeah. But I'm just saying that it has actually swapped. But now it may be diversifying, but that particular source of financing has actually changed. So in some sort, is it actually sort of strengthening the argument of viral Acharya in terms of indirect accommodation or some sort of captive base? So that again, it may again further affects the, the central bank's capacity to ensure more liquidity, because liquidity itself is a challenge, as said by Bhanumurthy sir. It's a challenge because liquidity is the sort of lubricant that is ensuring the wheel of economy going up. So that particular liquidity gets itself captived by the institutional backing. So how come all these particular things are going on, but still we can say the economy is going in a resilient manner? That is one thing.
It's exactly the type of work that they have to do.
I'll just quickly respond. So,
Yeah.
see, the way you are characterizing is that the economy is going into a tailspin. It is not. Okay. You have all these challenges. We continue to grow at, even if on a real basis or a nominal basis, we continue to grow at 10%. We are relatively well placed. Our job as Reserve Bank of India, we cannot take measures to ensure that there are structural reforms in the system. I don't have any tools. The only tool I have is interest rate and probably regulation and supervision. That's it. So we don't have any of those things. So it is not our place to go and tell, okay, informally we can tell the government, okay, you can make some of these reforms, but it is not our place to go and say that, okay, you should make this reform, that reform, all those things. We are an unelected technocrat. So we have to remember what exactly is our job. We don't have any role in allocation and distribution of resources. Our only job in public policy is related to stabilization. So we need to remember that. On current account deficit, it's a simple fact that if you are a growing economy, you are going to run a current account deficit. We are not China. We are not a manufacturing hub. So unless and until, and probably there are enough data points to suggest that if you don't increase manufacturing, okay, and rather than relying on services, manufacturing is something that you have to invest heavily. That will increase jobs. It will take care of. So, for example, one of the points that he was saying that quite a lot of the current account deficit is because your software exports have been enormously high. And that is, I mean, taking care of some of the trade deficit that is there. So you need to work on, again, not our maybe, right? Everything the government has to do. The last bit is on the central government securities. The limited point that we are trying to say, see, you forget about whether Mr. Viral Acharya said, you go to any economy, for government, there is always captive borrower. For the simple reason that everybody need a safe asset, right? It's a simple logic. The safest of asset is a government bond, because the government in its own currency is unlikely to default. Okay. If you have issued foreign currency denominated bond, you will. So everybody needs a safe asset. Then what you do is that you tell the banks you have to have more safe assets. Why? Because deposits has to be backed. You tell insurance companies you have to investment in safe assets because insurance policies has to be repaid, right? So it is it is design. It is not a bug in the system. It is by design that you want them to have these safe assets. You are absolutely right that design should not be taken to an extreme where the government treats, because they want it, let me continue to supply and continue to borrow, right? So that is where, I mean, as I said, one of the things that we wrote is that we said the bank and the state government nexus is going up, right? That itself is writing that word itself is difficult in a politically sensitive environment to say that, okay, the Reserve Bank of India is commenting on state borrowings, right? These are extremely challenging things. So my limited point is to say is that we are not in a tailspin. We have a serious problem when it comes to capital account, and that is something that we have to deal. But in order to deal with that we need a structural reforms, lot of structural reforms. We have to do a lot of ease of doing business. If you ask FIIs, even now for them to register for an FPA or an FI, there are so many these things. And for example, internally, we were having a last meeting of the FSDC subcommittee, and one of the members was saying that the one regulator gives them a permission, then there will be another regulator or an income tax authority says that you haven't met these conditions, right? So unless and until we ease some of those things, okay? And I'll give you a simple statistic, which I remember some time back. If you want to open a hotel in India, you need to have about 40 licenses you have to get, right? But if you want to own a gun in India, you require 10 licenses, okay? So you understand the priorities, right? So these are some of the challenges that you have, but none of these are in Reserve Bank of India's domain. So we need to be careful. We need to understand what is the remit to given to us as a legal mandate, operate within that, but at the same time, look at from their angle and then communicate as much as possible.
I think it was a wonderful discussion. I think we'll conclude by, if you permit, can I conclude? I don't think that anybody is.
No, I have I have one small suggestion.
You
For
have to
the
give
next-
overtime to us.
No.
Direct-
Yeah, just complete in half a minute. One is that, just inviting Mr. Ayappan Nair to MSC to make this presentation sometime in the month of August when we reopen. The second is for the next report. I thought if you can also look at, recently DICGC has done something, right? I mean, they have increased the insurance cover and all that. And then still having a tight regulation on the banking sector. I think these two can be looked at maybe going forward. The other one is, I think in the report you have covered extensively, the urban cooperative banks. I think I still feel it's still a black box, especially you just got RBI got under its purview very recently. But I think we need to do some more on what is happening in the urban cooperative banks. So these are the two suggestions I thought I would make, and one invitation to MS.
Sir, for the invitation. I'll reach out and then probably we can do it on a formal this thing and then come over. Happy to have this discussion. One limited point on the urban cooperative bank. See, when you look at financial stability, what you're looking for is something that can create a problem for the system. Right now, urban cooperative banks is not that large. Even if some of them fail, is going to create a problem for the system. But that doesn't mean that there are not problems. There is a lot of political connections associated with the UCBs, right? So there is a bunch of discussion happening. So why we don't cover so much in the FSR is because it is not a systemically important problem for us. Even because there are, I don't know, I mean, how many urban cooperative banks are there? At least some 1,500 to 2,000 something is there. Even if some of them fail, it is not a major problem for us. So that's why we try to. The second thing is, any analysis that we want to do, we need a lot of data. And the problem with some of these entities and non-bank financial companies is we cannot trust their data. So if I have the wrong data and then I make an analysis and we put it out there, then it becomes a problem, right? So those are some of the challenges that we are trying to probably come out with. We get more granular, good data. So for example, our ability to do stress test, we need a long time series to understand, okay, what will happen in previous stress periods, how it has evolved, but we don't have good quality data. So we'll try to do that as much as possible, but the coverage is limited to because of this simple reason that we think that they haven't reached a level for us to worry right now that if some of them fail, it creates a problem for the financial system as such. But that is not important. It is not that it is not important. It is been addressed through the supervisory aspect.
Okay, thank you. I think only we took 2 hours, but I think we are intellectually much enlightened, much better off at 5:30 p.m. today as compared to what we were at 3:30 p.m. today. And that we are, but I must tell you that RBI having the imbalance in our economy. That's the main problem, because when it comes to stabilization, RBI is doing a wonderful job. I mean, you are. But when it comes to, when you are talking about all the root of all these problems actually goes down to a context wherein 90% of the industrial workforce in this country get 25,000 rupees. And they are lured by offers, you take the 10 lakhs, and they overspend, consumption oriented, so to say, no investment. But then why they are what they are? We have to get back to the fiscal side, the other side of that. So when it comes to stabilization, we have an RBI who is their counterpart to put the other side of it, to talk about allocation and distribution. We don't have. That is a big gap in the economy. In fact, I must say that if you see within this perspective, you need a counterpart to reflect upon that, so that if we unless we fix these things together, I don't think that our will not be reaching anywhere. Anyway, but it was interesting, very nice. We will be in touch.
Yeah.
Thank you once again for my personal side. But we have a very official person, very specialized in giving vote of thanks. So I call my dear friend, Dr. Ranjit.
Okay, thank you, sir. Good evening, everyone. On behalf of Gulati Institute of Finance and Taxation, it is my privilege to propose vote of thanks for today's program. First of all, I would like to thank our chief guest, Sri Ayappan Nair, General Manager, Financial Stability Department, Reserve Bank of India, for his insightful presentation on the RBI Financial Stability Report 2026. His talk gave us a clear understanding of the current financial stability scenario and the challenges and opportunities we are facing. And I would extend my thanks to Professor N.R. Dhanimurthy for his valuable insights on perspectives on the FSR report, and also highlighting some of the missing part, and also the some clarity issues and all. I also thank Dr. Anup S. Kumar for his insightful comments, complementing to what Professor Dhanimurthy highlighted. Together, both the discussions basically enriched our today's discussion part. And I would like to thank our director, Professor K.J. Joseph, for his for chairing this program, and also his constant support, guidance, and encouragement. Basically, that is instrumental in making GIFT a vibrant place for academic learning and these kind of meaningful policy discussions. And my thanks to all the faculty members, research scholars, students, and other participants for your active participations and the interaction part as well for this session. And finally, I would like to thank the webinar coordinators, Dr. Kiran Kumar and Geeta Rani, the technical team, and all the administrative staff whose dedicated effort to ensuring the smooth conduct of this program. And thank you once again for being with us today, and we look forward for welcoming you to the next webinar series. Thank you. Have a nice evening.